Did an auditor really qualify an audit report for just 1.92 lakh rupees by ignoring issues involving more than 6,972 crore rupees? And can such a mistake lead to a 5-year ban from audit practice? The National Financial Reporting Authority, better known as NFRA, says yes. In this video, I will explain the entire DB Realty case, the allegations, provisions involved, findings of NFRA, penalties imposed, and most importantly, the practical lessons every chartered accountant, company secretary, and auditor must learn from this landmark order. Let's begin. First, who were the parties involved? The company was DB Realty Limited, a listed real estate company now known as Valor Estate Limited. The statutory auditor was Haribhakti and Company LLP. NFRA proceeded against two professionals, CA Chetan Desai, who was the engagement partner, and CA Rakesh Rathi, who was the engagement quality control reviewer, commonly called EQCR. After receiving information from SEBI regarding possible misstatements in the financial statements, NFRA started examining the audit conducted for FY 15-16, and what NFRA found was shocking. Let's talk about allegation number 1, the issue related to corporate guarantees and securities. DB Realty had provided guarantees and securities amounting to approximately 3,894 crore rupees in its standalone financial statements. Think about that. 3,894 crore rupees. This single figure represented almost the entire balance sheet exposure of the company. Now here's where things become serious. One of the guaranteed loans of 225 crore rupees had already become an NPA. Yet according to NFRA, the auditor neither obtained proper confirmations nor performed adequate audit procedures to determine whether these contingent liabilities had become actual liabilities. NFRA observed that the audit file did not contain sufficient evidence demonstrating professional skepticism. And this became the first major charge. Now comes the allegation that shocked the entire profession. Modified audit opinion. The auditor qualified the audit report for an amount of only 1.92 lakh rupees. Yes, just 1.92 lakh rupees. But at the same time, matters involving more than 6,972 crore rupees were merely disclosed under emphasis of matter. NFRA questioned this approach. The regulator asked, how can an auditor qualify a report for an immaterial amount while treating massive exposures involving thousands of crores merely as emphasis paragraphs? According to NFRA, this had the potential to mislead users of financial statements. This became the second major charge. Now let's move to the third allegation, loans and advances. DB Realty had loans and advances exceeding 1,326 crore rupees. A significant portion of these loans was granted to related parties. Several of these entities reportedly had negative net worth. NFRA alleged that the auditor failed to properly evaluate recoverability, failed to perform substantive testing, and relied excessively on management representations. In simple words, NFRA believed the auditor accepted management explanations without obtaining enough independent evidence. The fourth allegation related to investments. The company had investments of approximately 2,456 crore rupees. These investments were spread across subsidiaries, associates, and joint ventures. Many of these entities reportedly had weak financial positions and negative net worth. NFRA expected the auditor to carefully examine whether impairment provisions were required. However, NFRA concluded that adequate audit evidence supporting these investment values was not available on record. Now comes an allegation that every audit professional should pay attention to. NFRA did not stop at technical audit procedures. It examined the involvement of the engagement partner himself. According to NFRA, the engagement partner's role appeared limited to planning, reviewing financial statements, and signing the audit report. NFRA observed that there was inadequate involvement in major audit procedures and insufficient supervision of the engagement team. This led to another finding of professional misconduct. What about the EQCR? Remember, the EQCR is the final quality gate before an audit report is issued. NFRA alleged that the EQCR failed to challenge significant judgments, failed to identify major deficiencies, and failed to perform an effective quality review. In other words, the second line of defense also failed. Now, let's discuss the legal provisions. NFRA relied upon Section 132 of the Companies Act 2013, particularly Section 132(4), which empowers NFRA to investigate professional misconduct and impose penalties. NFRA also relied on Section 143 relating to auditor responsibilities. In addition, violations of several standards on auditing were alleged. These included SA 200, SA 220, SA 330, SA 500, SA 505, SA 705, and SA 320. For students preparing for examinations, this is an important practical application of auditing standards. Now comes the most important part. What did NFRA finally hold? After examining replies, audit files, and hearing the parties, NFRA concluded that the charges were proved. According to NFRA, the auditor failed to exercise professional skepticism. The auditor failed to obtain sufficient appropriate audit evidence. The auditor improperly modified the audit opinion. The auditor failed to adequately evaluate guarantees, loans, and investments. And the EQCR failed to perform an effective quality review. Therefore, NFRA held both professionals guilty of professional misconduct. And now the question everyone asks, what was the penalty? CA Chetan Desai, the engagement partner, was fined 5 lakh rupees. More importantly, he was debarred for 5 years. For 5 years, he cannot undertake audits or internal audits of companies and body corporates. CA Rakesh Rathi, the EQCR, was fined 3 lakh rupees. He was debarred for 3 years. This demonstrates that NFRA is willing to hold not only engagement partners but also quality reviewers accountable. Now let's discuss the biggest lessons from this order. Lesson number 1. Professional skepticism is not optional. It is mandatory. Lesson number 2. Management representations can never replace audit evidence. Lesson number 3. Materiality must be applied logically and consistently. Lesson number 4. An engagement partner must actively supervise the audit. Lesson number 5. An EQCR review must be substantive and not merely procedural. Lesson number 6. If a matter involves thousands of crores, auditors must demonstrate through documentation why they reached a particular conclusion. Final question. Was this merely a documentation failure, or was it a failure of professional judgment? That is the debate this order has triggered across the auditing profession. Comment below and tell me your view. Do you agree with NFRA's findings, or do you think the penalty was too harsh? If you found this case study useful, like this video, subscribe to Corporate and Securities Law Compass, and press the bell icon for more practical corporate law, securities law, and audit case studies. But wait, NFRA wasn't done. This is where the case takes a dramatic turn. And what NFRA found next was even more serious. Most professionals completely miss this point. Remember this for exams and practice. This single observation became the turning point of the entire case. Disclaimer: the content available on this channel, Corporate and Securities Law Compass, is provided solely for educational, informational, and knowledge-sharing purposes. The views, interpretations, opinions, and analysis expressed in the videos are based on the presenter's understanding of applicable laws, regulations, judicial pronouncements, regulatory orders, and publicly available information as on the date of publication. Nothing contained in this channel constitutes legal advice, professional advice, investment advice, financial advice, tax advice, audit advice, or any other professional service. Viewers are advised to consult qualified professionals before acting upon any information discussed in the videos. While reasonable efforts are made to ensure accuracy, completeness, and reliability, the presenter and the channel make no representation of warranty regarding the correctness, adequacy, or timeliness of the information. Laws, regulations, notifications, circulars, and judicial interpretations are subject to change, and viewers should independently verify the latest legal position. Any discussion of companies, securities, regulatory actions, investigations, enforcement proceedings, court cases, or corporate transactions is intended solely for educational analysis and should not be construed as an allegation, endorsement, recommendation, or opinion regarding any person, company, or entity. This channel does not recommend the purchase, sale, or holding of any securities, financial instruments, or investments. Any references to listed companies, stock prices, market events, or financial performance are for academic and educational discussion only. The presenter is a member of the Institute of Company Secretaries of India, ICSI. The views expressed on this channel are personal and do not represent the views of ICSI, any employer, client, organization, regulator, or any other institution with which the presenter may be associated. By accessing and viewing the content of this channel, viewers acknowledge and agree that they are using the information at their own discretion and risk.